Hello, this is Chris Matthews from TradeForexFundamentally.com. Today's video is a live Forex options trade on April the 29th. I'd like to show you in this video, firstly, what are Forex options and why they're really special for Forex trading, and two, how to select an options strategy based on the present market and your risk profile, and finally, a live demonstration of putting all this into action. So just a quick warning before we start, this is not investment advice, so don't take it as such. This is for educational purposes only. So let's talk about regular Forex trading at first. This is a profit and loss diagram. It's also called strategy payoff diagram. If we say that the pair that we're looking at, this is probably the British pound / Japanese yen, it's about 144 right now. So we can say we buy at 144, and if price goes up, going to the right means the price of the currency pair is going up, then our profit increases. We're at zero initially, and then we start to increase in profit. If price goes the other way, to the left, you see the numbers are going down, 140, 135, 130, then we lose. And that's the Forex market as most people know it. However, Forex options are a little bit different. Instead of having a straight line shooting up, you can have a kink here, which means that if you're buying a call, which is basically if you're bullish a currency pair, if price goes up, you start to make money, but if price goes down, you lose a little bit of money at first, but it's limited to the premium that you paid for the option. Puts are the opposite type of option. If you buy a put, you're betting on the currency pair decreasing in value. So if the pair starts to decrease in value, your options position value becomes more profitable. As you can see, the line starts going up as you go to the left. So the advantage is there's unlimited upside but limited risk, so you never get stopped out. You can put these different types of options called calls and puts together and combine them into all sorts of different structures, a simple one of which is below, which is called a straddle. If you're not sure which way price is going to go, but you know that there's going to be a big move in either direction, you can put on this strategy here and make money whichever direction price goes, as long as it moves enough. So how do you select the right type of options trade? You have a couple options. Firstly, you could do it yourself by analyzing the market and selecting an appropriate strategy based on volatility and price action. Or two, you could follow trade recommendations and let someone else do that work. So for this live trading demonstration today, we're going to actually do the second option of following trade recommendations. So what I'll do is I'll just show you some recent market analysis we did with the British pound / the Japanese yen. And what you see here is one of our trade recommendations that will be coming out really soon, and it's going to look something like this. This is just a sample, but I mentioned something earlier about us coming out with an options trading signal service or trade recommendation service, and this is an example of a quick signal on the British pound / Japanese yen from a week ago. Some supporting reasons for going long this pair, in other words being bullish this pair. Most bad news should be discounted by now. Fundamentals are improving. If you look at indicators such as GDP, current account, PPI, and consumer and business sentiment has been rising. If we look at the other currency in the pair, the yen carry trade has been rising, currency outflows have been increasing, and there's general economic distress. So those aren't very good indicators for Japan, which means that it's a good indicator for the British pound / Japanese yen pair. So it's always important to consider any contradictions to your supporting reasons. And in this case, we have the fact that UK sentiment has been very negative, and there's problems with the government. I won't get into all the details here. Then we look at entry notes. So this says that any time below 145 is good for entry, and plan to exit once the spot price is above 155. Okay. So if we scroll down to the second page here, there's some suggested option spreads. There's different types of trade structures here. There's a bull call spread, something called a call spread with a put, and all these things. You don't need to know what all these complex names are here, but you do need to know certain numbers here that are important to you. Net premium, this is the amount that you pay to buy the options. Value at risk, that means how much money you have at risk for this trade. And these are numbers that are related to the sensitivity of your position to the market, and we can cover that on a different day. But the point is, these are the important numbers here. This is the important information. This is a signal right here. You want to go long a 145 call. That means you're buying a call with a strike price at 145, and you're shorting a call with a strike price at 156. And both of these options are expiring on July 15th. And you can pick all these numbers here. So we're going to go right now into a brokerage platform so that you can see how we actually enter these trades. But first of all, let me just show you another profit and loss diagram here. In this trade recommendation service, 2 to 3 different risk profiles are suggested depending on whether you're a conservative trader or a really aggressive trader. So for me, I'm going to pretend I'm a little bit more aggressive today, and I have a $10,000 account and I'm willing to risk about 4% or something. So that's going to be about $400 here. So this pink line here shows that the maximum risk for this trading strategy is around $400 here. I think the precise number is actually 383 here. So that's within my risk tolerance. So I'll follow this one, and this pink one here, it shows that it's a call spread. So I'm going to play this trade structure. You don't need to do all these. You just pick the one that's closest to your risk profile. So this one says long 145 call and short 156 call. So I'm going to go into my platform right now. I'm going to go long a 145 call. So I select British pound / Japanese yen here. This is a Saxo Trader platform. And then I can select a strike price at whatever price I want, but the recommendation said 145. Okay, and the expiry date is already in there, 15th July 2010. So I go ahead and I look at the bid ask. I would have to pay a price of 3.77 for this, and I'm buying one lot, which is 10,000 units of the base currency. So that turns out to be 37,700 yen, which is about $377 if you just use an approximation. Okay, so I go ahead and I enable trading, and then I buy that. It shows me a trade confirmation. I just bought that, and then now I want it. What was the next one? I wanted to sell a 156 call, go short of the 156 call. So I just go ahead and type in 156 here for the strike price, and same expiry date, same position size, and I go ahead and sell that for 0.27, so that's equivalent to 2,700 yen. So I go ahead and sell that, and it gives me a confirmation, and I'm done. I just made the trade. So you can see how easy it is to just follow these one-line recommendations here, or two-line recommendations here. Okay, so I just want to emphasize again that this is just an example here, and the real trade recommendations are coming out pretty soon. And you know, we could be wrong on this, we could be right, but it doesn't matter, because in the long term we're more right than we are wrong, and that's what's important. It's having that edge. So I wanted to present this more for an educational example so that you can understand how we actually go in and decide how to trade and do what we do to make money in this market. So I'll talk to you again soon.